Do you remember gold, that dense, shiny metal humans have treasured for millennia? Now imagine a piece of code, digital, frictionless, global, that also claims to store value. Over the past decade, that code, Bitcoin, has challenged what we thought a store of value could be. So here's the question: which is better, gold or Bitcoin, when the goal is preserving wealth over time? Stay with me, because by the end of this video, I'll give you a decision framework you can use yourself. Here's what this video covers. First, we'll define what store of value actually means in a rigorous but intuitive way. Then we'll dive into gold, why it has held that title for centuries, and into Bitcoin, how it's trying to rewrite the rules. Next, we'll go metric by metric: returns, volatility, drawdowns, liquidity, correlation. Then we'll talk real-world trade-offs: custody, regulation, crisis performance, and risk exposures. After that, we debunk common myths. Finally, I'll walk you through how you might think about this for your own portfolio. By the end, you won't need a guru, you'll have a lens to judge. Quick disclaimer: this is educational content, not financial advice. Nothing I say here should be construed as a guarantee or promise. Always do your own work, consult professionals, and know your risk tolerance. Alright, with that out of the way, let's start by building a foundation. What does store of value really mean? Store of value is a concept, not a brand. An asset that stores value means that over time, its purchasing power is preserved or ideally grows despite inflation, uncertainty, or regime changes. But to judge one contender versus another, we need criteria. Let me walk you through 6 core ones. First, scarcity. If you can endlessly print more, your creation loses value. Second, durability. Will it degrade, rust, or disappear? Third, portability. Can you move it easily across borders or time? Fourth, fungibility and divisibility. Can you break it, exchange small units, and treat one unit like another? Fifth, verifiability, trustlessness. Can you confirm authenticity without relying on a centralized gatekeeper? And sixth, liquidity and market depth. Can you buy or sell large amounts without destroying price? These aren't just theoretical. Every asset stacks up differently across these axes. Before we leap into gold, here's a teaser. Gold nails scarcity and durability, but struggles at portability and trustless verification. Bitcoin flips some of those trade-offs. More on that soon. If you're getting value so far, clarity around definitions, rethinking assumptions, hit like and subscribe. I post deep dives like this regularly, and it helps this content get seen by folks who need it. Alright, now gold. Gold has been used as money, ornamentation, reserve, and wealth store for thousands of years. It enjoys universal recognition. In every culture, people understand that gold is valuable. From the dawn of recorded history, societies mined it, hoarded it, and traded it. That built narrative, trust, myth, which gives it an edge. On the scarcity axis, gold is physically finite. You can mine more, but costs escalate, so supply growth is modest and slow. On durability, gold does not corrode, decay, or vaporize. On portability, here gold is weak. Transporting bars across borders is heavy, expensive, and risky. On divisibility, you can mint coins, small bars, but creating arbitrary fractions has cost and trust overhead. On verification, you need assay labs, trusted hallmarks, provenance, certificates, partly centralized institutions. On liquidity, gold markets such as futures, ETFs are deep, but slippage and cost matter for big volumes. Now, how has gold actually performed? Over the past decades, gold has provided modest real returns, beating inflation in many regimes, but far from exponential. It has often outperformed in periods of crisis or currency weakness. It also has costs: storage, insurance, vaulting, and transport, and these eat returns. During extreme shocks like hyperinflation, war, regime collapse, gold often holds more trust than local currencies, but it's not bulletproof. Why this matters next. Gold is a tough benchmark. Bitcoin has to beat it not just in return, but in resilience and trade-offs. Bitcoin was born in 2008 out of crisis, coded in 2009. Its white paper laid out a peer-to-peer electronic cash system, but over time, many embraced it as digital gold. What gives Bitcoin its store of value claim? Scarcity. Its supply is capped at 21 million coins, and issuance halves approximately every 4 years, the halving event. Durability. Digital bits don't degrade. As long as nodes and networks exist, bits persist. Portability. Can you send $10,000 across the world in minutes? Bitcoin can. No physical border, no shipping. Divisibility, fungibility. Each coin can be divided into 100 million sats, or satoshis. Every sat is fungible in principle. Verifiability. The blockchain is public, decentralized. You can verify history without trusting a central authority. Liquidity. Major exchanges, derivatives, wallets, deep liquidity exists. But the critical caveats: the network must stay secure. Custody is not trivial. Losing your private keys means losing everything. Regulatory risks loom. Bitcoin has faced massive drawdowns, yet has recovered and exceeded previous peaks. Its correlation to other risk assets sometimes spikes in liquidity crunches. Yet for believers, its programmatic certainty and pure digital nature represent a new paradigm of money. If this is blowing your mind, thinking of combining old money and new, share this video with one friend who's skeptical of Bitcoin. Let's get more smart people into the conversation. Why this matters next. Getting into empirical metrics, now we see how they stack head to head. Let's put gold and Bitcoin under the microscope. Side by side, metric by metric, return historical performance. From 2011 to 2025, Bitcoin has averaged eye-watering gains, in some periods over 100% annualized, while gold hovered in the single digits. Between October 2015 and October 2025, Bitcoin appreciated by over 14,000% relative to gold, but that's with volatility baked in. Gold's annualized volatility is modest, often in the 10 to 15% range. Bitcoin's is extreme, 60 to 100% plus in some years. Bitcoin's worst bear cycles have seen 70 to 80% drops. Gold's worst over comparable decades might be 20% loss or so. Sharp, risk-adjusted returns. Even after adjusting for risk, Bitcoin has often delivered high reward per risk in full cycle periods, though this depends heavily on timing and the start-end date. Correlation and diversification. Gold has often had low or negative correlation with equities in crisis. It acts as a hedge. Bitcoin's correlation moves. Sometimes it behaves like a crypto risky asset, at other times and decouples. Market cap and scale. The total above ground gold stock is enormous, hundreds of billions to low trillions in US dollar. Bitcoin's market cap is smaller by comparison, though in growth mode. Liquidity and transaction costs. Gold has bid-ask spreads, vaulting fees, insurance, dealer premiums, and delays for physical settlement. Bitcoin has exchange fees, network fees, gas fees, and slippage, especially during stress periods. Overall, Bitcoin wins many categories in raw returns and certain efficiencies. Gold holds steadier ground in drawdown resilience and psychological safety. And why this matters next. Metrics alone don't decide. Real-world risks can tip the balance. Let's talk about when theory collides with chaos. The trade-offs you cannot ignore. Custody and loss. Gold must be stored, insured, guarded. Bitcoin must be key managed. Lose keys, you lose access. That's both power and peril. Regulation and government risk. Gold can be seized, confiscated, and history of that exists. Bitcoin can face bans, capital controls, delisting of exchanges, network risks and technical threats, bugs, quantum computing. 51% attacks are non-trivial risks for digital assets. Liquidity crunches and stress regimes. In a global panic, everything sells. Bitcoin can collapse in correlation with risk assets. Black swans and systemic shocks. Extreme systemic failure, such as internet down, major hacks, might impact Bitcoin more. But physical risks like war and theft threaten gold too. Inflation, monetary policy, and currency debasement. Both assets hedge against inflation and debasement of fiat, but their sensitivity differs. Psychology, narrative, adoption cycles. Gold is culturally embedded. Bitcoin depends on technological trust, network effect, narratives. In climate of uncertainty, both assets have failure modes. The key is spacing, conviction, and hedging. And why this matters next. Before you pick, let's bust myths people cling to. Myth: Bitcoin will 100x from here, guaranteed. The reality: past performance is not a prediction. Every bubble resets expectations. Myth: Gold is obsolete, a relic. The reality is gold still plays vital roles in central bank reserves, jewelry, and industrial use. It won't vanish overnight. Myth: You must pick one and ignore the other. The reality is they aren't mutually exclusive. They fulfill different portfolio roles. Myth: Bitcoin has no real use, it's just speculation. The reality: its network, liquidity, permissionless transfer capability, and store of value narratives offer real optionality. Avoid mistakes: over leverage, lack of rebalancing, ignoring security, chase timing. These kill more portfolios than the assets themselves. And why this matters next. Now you're equipped, time to map to you. Here's how I'd build a beginner to intermediate playbook. Step 1. Assess your time horizon and risk tolerance. If you can stomach big drops, Bitcoin's upside is compelling. Step 2. Allocate prudently. Start small, 1 to 5%. If new, don't bet the farm. Step 3. Commit to security and custody early. Get a hardware wallet, multi-sig, audit your gold vault practices. Step 4. Rebalance periodically, lock in gains, trim extremes. Step 5. Monitor macro red flags such as regulation, systemic instability, and adapt. You don't have to go all in. Experimentation with small allocation helps build conviction or caution. We started with what store of value means, the axis to judge. We saw Vold's deep legacy, its real strengths. We saw Bitcoin's protocol design, bold trade-offs, and empirical performance. We compared returns, volatility, drawdowns, correlation, and liquidity. We evaluated real-world risks and debunked myths. And now, you have a framework to reason this yourself. There's no universal winner. In some regimes, gold might outpace, and in others, Bitcoin would dominate. Your role is to tilt smartly, stay humble, and manage risk. If you want deeper dives on custody, allocation, or stress testing, tell me and I'll build them next. If you found this useful, hit subscribe and ring the bell so you don't miss future deep dives. Drop a comment. If you had to pick one today, which would it be? Gold, Bitcoin, or a mix? Explain why. Also, check out this video next. It's linked on the screen. Why you should start buying Bitcoin now. Thanks for watching Smash Crypto Zone. I'll see you in the next one.